Everybody, welcome to the Covenant Video Market Newsletter for July. My name is Karl Eggerss, and in this video, we're going to cover a few things, get you caught up to speed on what's going on in the markets. First of all, what goes down must go up. Well, apparently so for May and June, right? May was a horrible month. June, the markets turned around and did a V-shaped recovery pretty quickly to new highs. And in fact, it was the best June since. We'll talk about that. And then a rate cut is likely this month. A trade truce between President Xi of China and President Trump of the U.S. And then negative interest rates. Have you heard of such a thing? Would you lend your money to somebody, and instead of them paying you interest, you pay them interest? That is happening around the world. We're going to show you a chart on that. And then gold has gotten a little bouncy, and we're going to talk about why is gold actually shining right now. All right, first things first, we will show you a picture of the S&P 500. This is of course, the 500 biggest U.S. companies in the United States by market capitalization. And what you'll notice on here is that really since 2016 and 17 and 18, the markets were moving higher, and then pretty much for the last year and a half, we've seen them move sideways. Now, it hasn't been flat, of course. We've had a lot of volatility, but we have seen the markets overall from point to point not make much progress. In fact, that blue line that you're looking at is what's called the 200-day moving average, which is just simply a smoothing mechanism to take the last 200 days prices, average them out. A new one comes on, it drops off the one from 201 days ago, and you get this smoothing mechanism and the smooth line. And it's really just to show you the trend of the market. And so you can see really in the last year and a half, we've seen the market flatten out. And of course, we had a big sell-off when all of this tariffs and trade war started with China in early 2018. Then we recovered in the summer of 2018 to go up to new highs. And then, of course, we had the really bad fourth quarter of 2018 when we started to see that the Fed sounded like they were going to continue to raise rates as there were some subtle signs that the economy was starting to slow a little bit, and investors threw a hissy fit. You combine that with tariffs and a trade war, and we had about a 20% sell-off in the fourth quarter of 2018. And we come into Christmas Eve. That was pretty much the low, and the markets have rebounded quite nicely. And as we started to continue to see progress the last few months on trade, then we saw that apparently either China or the U.S., somebody backed out of the deal, and it all seemed to unravel. And so we saw tariffs kick in again, and we saw a really bad month in May, which we talked about in last month's newsletter. And we saw a really bad May, and then of course we see a big turnaround in June. So why did we get the big turnaround in June? Really two main things. Number one, and probably the most important right now, is don't fight the Fed. The Federal Reserve has not only changed their tune, they are not raising interest rates, and that's why we saw the gains early part of the year. But on top of that, they really now have essentially said that they are going to cut interest rates this month. And so the market is fully expecting that. You can see in the bond market and the futures markets, they're pricing in a Federal Reserve rate cut. Now, is that always a good thing? Well, that usually means that the economy is slowing. And as you can hear, this is a picture of interest rates, what the Federal Reserve controls. And those Fed funds rates, as they lower them and raise them, the red bars you're looking at, the vertical ones, those are recessions. So if you notice, there have been times over the last few decades that we're in the middle of a recession, and then the Fed starts to cut rates. There have also been times, the last couple of times, the couple of recessions we've had, where the Fed started to cut rates, and then a few months later we were in a recession. So many people believe, well, if they're cutting, surely recessions are on the corner. Not necessarily the case. Notice what happened in 1995. They actually cut interest rates during that cycle. And of course, 95 went on to be a tremendous year, and so did the years afterwards, all the way until really the end of the dot-com bubble. So this picture shows that there are many different scenarios that can happen when the Fed's cutting rates. They will cut during a recession, sometimes they cut before a recession, and sometimes they're cutting after a recession's already started. And we don't know what that's going to look like. Many of our indicators would suggest that the economy is slowing, the global economy is slowing, but not so much that it's in a recession yet. Okay, and also on top of that, it's been a good economy, just not great. And we're still getting some mixed signals, but we are seeing a little bit of a slowdown. So the Fed probably raised rates one too many times last year, and now it looks like they're going to undo that by cutting once, twice, maybe even 3 times coming up in the rest of the year. And you can see on this chart here that they have been raising really since December of 2015, and they've been kind of flat in the last few months. Look for them to cut. And probably the most concerning thing long term is that every time they have it happens, it's lower than the peak on the prior rate hikes. So we're essentially getting lower and lower and lower rates, and that's why the fears always become, are we going to be Japan, where we just can't raise interest rates enough because we have such a slow growth economy around the world. So yet to be seen what happens that long term. Now, the good news for the economy is we are at the record for the longest expansion going all the way back to the 1800s, Civil War times, that we are at 121 months during this economic expansion. New record. So that is the good news. The bad news is that how good can it get? Is this the best it can get? So we have unemployment very low. We have an economic expansion very long. You have a truce on a trade war. So is this as good as it gets? Some people believe this is as good as it gets. The next cycle is we're going to start slowing down and we will enter recession. Now, again, speaking of the truce, we did get, of course, late in the month, a truce between President Xi of China, President Trump of the U.S. at the G20. Basically, we're not going to put on any more tariffs yet. So it was really a delay. We still haven't seen a trade deal, and I've been saying on my podcast for many months that a trade deal is a big, big deal, and it's going to take a long time. What we can hope for, though, is obviously continued progress, no new tariffs, etc. And it seems to be that we're getting that as we speak, and so the markets have gone up to new highs. Now, going back to the Federal Reserve is more than likely going to cut in July and perhaps 1 or 2 more times this year. Is that really a good thing? Again, generally speaking, stocks go up when the Fed cuts rates, but is it a good thing for the economy? It seems like if they are cutting interest rates, the economy is probably slowing down, which it is right now. Does it continue, or can they cut to speed it up? Now remember, interest rates have already fallen a lot. A 10-year Treasury bond yield is under 2%, or has been very recently. So interest rates are already low. That could be some stimulus going forward. But I want to show you a picture of this. This is really interesting and a little scary too. This comes from Charlie Bilello, and it shows how many bonds around the world have a negative interest rate. In red are all the bonds that are literally have a negative interest rate, and the green are ones that have a traditional positive interest rate. So for example, this is as of a couple of weeks ago, but in Switzerland, if you were to buy a bond in Switzerland, a 30-year bond, you have to pay them interest to hold your money. Germany, 15 years, and it's still negative. In fact, the U.S. on this picture is really the only country on here that has positive interest rates all the way from their 6-month bonds all the way up to the 30-year bonds. So this is something that is a little scary, and we are actually at a new record. Over $13 trillion of bonds around the world have negative yields or negative interest rates. And remember, though, if that doesn't make sense to you, the whole point is a lot of this is about currencies. A lot of this is about trying to stimulate your own economy. So if interest rates are low, more people theoretically will buy stuff and borrow, and it speeds up the economy. And that's what's happening here. But this has been good for gold. The next picture I'm showing is, interestingly enough, the price of gold in gold, the color gold as well. And in the blue is the amount of debt around the world that's negative yielding. Now, it's on two different scales, but you can see the path is the same. So when the blue's going up, that means there's a lot of bonds around the world that are paying negative interest rates. As that goes up, gold has gone up as well. So if you think that's going to continue, gold should continue to do well, and vice versa. Now, gold over the long term, some people believe it's held up with inflation. Some people don't. Bottom line is it's very volatile. It can move opposite or differently than other asset classes. And for the most part, it generally has been an inflation fighter. But having said that, it hasn't been in the last few years, and it's been very unpredictable, as it normally has been. So generally speaking, it's been more of a trading vehicle, whether it's for days, weeks, or months, versus something somebody might put in their portfolio and hold for the long term, because it will go literally 5, 10, 15 years at times and make no money at all. So be very careful with gold, but if you want to know why it's going up, this is probably it. Now, as we sum up, again, we'll go back to the picture of the stock market here, and you can see it's recently broken out to kind of a new high, all-time high. Is that going to continue or not? Things to consider in July. We have a Fed meeting. If they cut interest rates, is that already baked in the cake? Is that everybody already expected that? Does the market sell off just because of that? And it already happened. So in other words, it's a buy the rumor, sell the news scenario. Number two, do we actually continue to get progress on trade? Or does that break down, as it has so many times? And do these low interest rates persist as we enter earnings season? So the corporate profits are really something they hold the key in July, because, again, if those are good and companies continue to say, look, business is strong, the sales are good, profits are good, the market can continue higher. All of our internal data would suggest that the stock market is still in a bull market. There's no early signs of a bull market becoming a bear market. In fact, one of the things being tossed around Wall Street is that small companies are underperforming large companies. And when that happens, surely the stock market's going to fall. Not the case if you look at the data. A lot of times, after they've already underperformed, they turn around, and that usually leads to gains. So be careful where you get some of the data you're getting. Now, it is true, over the long term, what happens in a bull market that becomes a bear market? Small companies tend to underperform first, then it bleeds over to medium-sized companies, and then the large companies are kind of the last to fall. It's because they're the most defensive. Those are the ones people are hesitant to get rid of out of their portfolio. So that's kind of the theory. But there are no signs, the hood of the stock market, supply and demand, that we are entering a bear market. Now, can a correction happen? Yes, at any time, for any reason. It can be a tweet. It can be a breakdown in trade talks. The truce is not a truce anymore. The Fed says we're going to cut, but that's it. We're not going to cut anymore. There's lots of reasons why we could have a 10, 15% drop in stocks, and that generally around 15% is the data JP Morgan suggests that we get each year as a drawdown or a drop intra-year. And we had a 20% last year. We haven't really had anything this year. So we will get some volatility at some point. But again, it all goes back to financial planning 101 and having a diversified portfolio to kind of weather a lot of these storms. But right now, if you want to know why the market is at an all-time high, which a lot of people have been skeptical of this, sentiment, this is another picture we're putting on the screen before we wrap up. There's a lot of people who don't believe that the market should be higher, and they're worried about this and worried about that, and there's always things to worry about. But because there's a lot of people that don't believe the market should be here, they obviously have money on the sidelines, and oftentimes that is more fuel for higher prices. Once all your neighbors are agreeing the market's at a high, they want to buy more stocks, and everybody agrees with that, that's the time you enter potentially a bear market coming. And we don't feel like we're there yet. So not only is sentiment a contrarian indicator, it's still good right now. And we also have the internals of the market that are still good. And we have a Fed that is accommodative. And if we can get a trade deal and earnings are good, there's no reason why the market can't continue to move onward and upward. So in the short term, yes, we could get a sell-off for any reason. And it could just be the fact that it's just time for people to take some profits. So be on the lookout for that. But it was a good month of June. and it is something that hopefully will bad month of May. If you have any questions, let us know. Take care and have a